Ladies and gentlemen, Asian guy here. We have spent the last few days analyzing the human element of the silver market. We looked at the bankers, the miners, the stackers, and the corrupt regulators. We looked at the emotions, greed, fear, and betrayal. But today, I need you to understand that the next move in silver, the move that takes us to 100, will not be decided by a human being. It will not be decided by a trader on the floor of the NYSE shouting buy orders. It will not be decided by Jerome Powell. It will be decided by a black box. It will be decided by lines of Python code. It will be decided by artificial intelligence. Welcome to the world of high-frequency trading, HFT. Welcome to the world where 90% of all volume is executed by machines that think in nanoseconds. For the last 10 years, these machines were programmed with a simple instruction: sell rallies. They were the guardians of the suppression. Every time silver poked its head above the moving average, the AI detected it and slammed it down with a hammer of paper contracts. It was a mean reversion algorithm designed to kill hope. But this Monday, the code changes. The Monday morning panic isn't going to be men running around with their hair on fire. It is going to be the silent hum of servers in New Jersey and Chicago overheating as they process a new reality. The data input has changed. The CFTC report we discussed, the one showing US banks flipping net long, is not just a PDF file for you and me to read. It is data fuel for the most powerful supercomputers on Wall Street. You have to understand how modern hedge funds work. Funds like Renaissance Technologies, Citadel, and Bridgewater. They don't have guys sitting around reading the Wall Street Journal. They have web scrapers. They have natural language processing, NLP, AI. These bots scour the internet 24/7. They download every government report the millisecond it is released. They parse the text. They analyze the tables. They compare the data to historical averages. And what did the AI just read? It read that the smart money, the commercials, the US banks, have switched sides. In the logic of an algorithm, this is a critical state change. The AI operates on probability. For 40 years, the probability of silver crashing was high because the banks were short. The AI was programmed to follow the banks. It was a follow the leader algorithm. But now, the leader has turned around. The leader is marching up the hill, and the AI, devoid of emotion, devoid of bias, simply updates its weighting. It moves silver from strong sell to strong buy. It creates a new directive: buy dips. This shift is invisible to the naked eye until the market opens. But when that bell rings on Monday, trillions of dollars of algorithmic capital are going to try to fit through a very small door. The AI doesn't care about the fundamentals. It doesn't care about solar panels or Samsung batteries. It cares about momentum and flow. And the flow signal just turned green. This is the algorithmic pivot. It is far more dangerous than a human pivot. A human trader might hesitate. A human might think, well, silver has disappointed me before, maybe I'll wait. The machine does not hesitate. It executes. It sees the signal and it fires the order. Bam, done. And because these machines are all looking at the same data, they all fire at the same time. This creates a liquidity vacuum. The offers on the screen disappear. The price gaps up. $30, $32, $35 in minutes. This is called a flash rally. We usually see flash crashes. But now the conditions are set for the opposite. The Monday morning panic is the panic of the underweight funds. Imagine you are a massive macro hedge fund managing $50 billion. Your AI model manages your portfolio. Suddenly, the model calculates that you have zero exposure to the hottest asset class on the board. The model screams, risk alert, not because you are losing money, but because you are missing the trend. In the institutional world, missing the trend is a fireable offense. So the AI engages chase mode. It starts buying aggressively to catch up to the benchmark. And who is it buying from? There are no sellers. The US banks aren't selling, they are long. The stackers aren't selling, we are holding. The miners aren't selling, they are tapped out. So the AI has to bid higher, and higher, and higher. This is the feedback loop from hell for the shorts. The AI doesn't negotiate. It doesn't place a limit order and wait. It places market orders. It sweeps the book. It eats every contract in sight until it fills its quota. We are entering the era of machine-led price discovery. The suppression was manual. The explosion will be digital. The spoofing programs of the past, the ones that placed fake sell orders, are being turned off. Why? Because spoofing only works if the trend is down or sideways. If you try to spoof a market that is ripping vertical, you get run over. The spoofing bots are being retired. The trend-following bots are being activated. And these bots have massive firepower. We are talking about leverage. When an algorithm detects a 3 sigma event, a statistical move that is rare and powerful, it increases leverage. It borrows money to bet bigger. The flip of the US banks is a 6 sigma event. It is a statistical impossibility in the old model. So the AI interprets this as a black swan to the upside. The panic will be silent, but the charts will be screaming. You will see green candles that defy gravity. You will see technical resistance levels, levels that human chartists have drawn lines at for years, smashed in seconds. The AI doesn't care about your double top at $30. It calculates that the momentum energy is sufficient to break it, so it buys the breakout. This is why technical analysis might fail in the short term. Traditional TA assumes human psychology, but we are moving into a phase of quant psychology, the psychology of math. The math says, the suppressor is gone, the path of least resistance is up, execute. Monday morning is the start of the machine war. The short algos, the ones held by the foreign banks we discussed, are going to fight the long algos, the trend followers. But the long algos have the momentum. They have the fresh data. They have the wind at their backs. The short algos are fighting gravity. And in a war between machines, the one with the better data wins. The data says, go long. The data says the squeeze is on. The panic is real. The target is $100. Let's dive deeper into the brain of the beast. How exactly does the AI read the market? How does it decide that today is the day silver goes to the moon? We need to talk about sentiment analysis and intermarket correlations, because the AI isn't just looking at the price of silver, it is looking at everything, and everything is pointing to a breakout. Modern algorithms use web scraping to read the entire internet. They read Reddit, yes, Wall Street Silver. They read Twitter, they read Zero Hedge, they read the financial newswires. They are looking for keywords. Shortage, deficit, squeeze, bank default. For years, the sentiment score for silver was negative. The internet was full of people complaining about manipulation, about price smashing, about underperformance. The AI read this sadness and translated it into a bearish signal. It learned that silver investors are weak, depressed, and likely to sell on any rally. It profited from your misery. But in the last 3 months, the sentiment has shifted. The AI is picking up new keywords. Samsung, solar, breakout, victory. The tone has changed from despair to aggression. The AI detects this retail rage. It detects the formation of a mob. And contrary to popular belief, smart algorithms love mobs. They don't fight the mob, they front-run the mob. The AI sees the chatter about the CFTC report. It sees the viral videos. It sees the engagement numbers spiking. It calculates that a massive wave of retail buying is incoming. So what does the code do? It buys first. It buys on Monday morning at 4 a.m. London time, hours before the US retail investor wakes up. It wants to buy the silver at $30 so it can sell it to you at $35. This is the self-fulfilling code. The AI predicts a rally, buys to profit from the rally, and by buying, causes the rally. It is a loop. And once the price starts moving, the momentum algos kick in. Momentum algorithms are simple creatures. They follow Newton's first law. An object in motion stays in motion. If silver is up 3% in an hour, the momentum algo buys. If it goes up another 1%, it buys more. It adds to the winner. It pyramids the position. This creates a parabolic arc. In the past, the banker algos, the suppressors, would step in to stop this momentum. They would sell into the strength to kill the rally. But as we proved, the bankers have flipped. Their suppression algos are turned off. So now there is no ceiling. The momentum algos are pushing on an open door. They are expecting resistance, finding none, and accelerating. Now, let's talk about correlations. The AI looks at the dollar, DXY. It looks at gold. It looks at yields. Usually if the dollar goes up, silver goes down. That is the standard correlation. But recently that correlation is breaking. We are seeing days where the dollar is up and silver is up. To a human, this is confusing. To an AI, this is a regime change. It signals that silver is decoupling from the currency trade and becoming a safe haven or strategic asset. When correlations break, the AI resets its models. It realizes that the old rules don't apply. It starts treating silver like a tech stock, like Nvidia. It starts pricing it for growth, not just as a currency hedge. And the most powerful code of all? The arbitrage bots. These bots look for price differences between markets. They look at the Shanghai Gold Exchange, SGE, versus the COMEX. Right now, silver is trading significantly higher in China than in New York. The arbitrage bots see this free money. They buy cheap in New York, driving the price up, and sell dear in Shanghai. This ARB is relentless. It acts as a tow truck, dragging the COMEX price up to match the Asian price. And since the Asian price is exploding due to industrial demand, the bots are forcing the West to reprice silver. You cannot stop an arbitrage bot. As long as the price gap exists, it will buy. The Monday morning panic is largely driven by these arbitrage bots waking up to the new CFTC data. They realize that the US banks are no longer defending the low price in New York. This means the gap will close fast. The bots will hammer the ask button until the COMEX price equals the Shanghai price plus shipping. And we haven't even mentioned the ETF algos. When investors buy shares of SLV or PSLV, algorithms automatically go into the futures market to hedge or acquire metal. If the retail panic spreads to the stock market, the ETF buying becomes a massive hydraulic press, pushing the futures price higher. The scary part? These machines don't know the value of silver. They don't know that silver was money for 5,000 years. They don't know about the Constitution. They only know numbers. And right now, the numbers say buy. If the numbers said sell, they would crush us. But for the first time in a generation, the code is aligned with the stacker. The AI has become our unintended ally. It is a mercenary. It fights for the side with the strongest trend. And right now, thanks to the banker flip and the industrial famine, the bull trend is the strongest force in the financial universe. The code is self-reinforcing. Higher prices generate more bullish sentiment signals. More bullish sentiment generates more buying. More buying generates higher prices. It is a positive feedback loop that can send an asset to the moon in weeks. We saw it with GameStop. We saw it with crypto. Now, the eye of Sauron, the eye of the AI, has turned its gaze to silver. And silver is a tiny market. GameStop was a small stock. Silver is a small commodity. When the global liquidity hose of the AI world turns towards silver, the cup overflows instantly. The panic isn't that the price is crashing. The panic is that the price is running away. The panic of I can't get in. Monday morning, the code executes. The logic is irrefutable. The trap is sprung. And the silicon brains of Wall Street are about to teach the world a lesson in supply and demand. Now we arrive at the engine room of the rocket. We have talked about the buying pressure, but there is a specific mechanical phenomenon that turns a rally into a vertical line. It is called the gamma squeeze. It sounds complicated, but I will break it down because it is the reason silver is going to $100. This involves the options market. Traders don't just buy silver futures, they buy call options. A call option gives you the right to buy silver at a specific price, the strike price, by a specific date. Let's say silver is at $30. Speculators and the AI start buying $35 call options, $40 call options, even $50 call options. They are betting on a spike. Who sells these options? The market makers, the dealers, banks like JP Morgan, now that they are long, or the unfortunate foreign banks. When a market maker sells a call option, they are taking the other side of the bet. They are short the option. If silver goes to $100, they lose a fortune. So they have to hedge. They have to protect themselves. To hedge a call option, they have to buy some of the underlying asset. They have to buy silver futures. The amount they have to buy is determined by a math variable called delta. When the price of silver is far below the strike price, say silver is $30 and the option is $50, the delta is low. The dealer doesn't have to buy much silver, but, and here's the magic, as the price of silver rises and gets closer to $50, the delta increases. The dealer has to buy more silver to stay hedged. This is where gamma comes in. Gamma is the speed at which the dealer has to buy. As the price explodes upward, gamma spikes. The dealers are forced, mathematically forced by their own risk management computers, to buy massive amounts of silver futures into a rising market. They are not buying because they like silver. They are buying because they sold the option and they are terrified of being exposed. They are buying to cover their nakedness. Now imagine the Monday morning panic. The AI algos rush in and buy futures. The price jumps from $30 to $32. Suddenly, all those $35 call options that looked worthless yesterday are now in play. The dealer's computer screams, gamma risk, buy hedges. So the dealer buys futures. And this buying pushes the price from $32 to $34. Now the $40 calls are waking up. The computer screams again, buy more. This is the gamma loop. Buying begets buying. It removes human decision-making entirely. A human dealer might say, this price is too high, I won't buy. But the risk algorithm says, you are unhedged, you are violating risk limits, buy now. It executes the trade automatically. This is what happened to GameStop. It wasn't just people buying the stock. It was the market makers being forced to hedge the massive amount of call options that Reddit bought. In the silver market, the call wall is massive. There are millions of ounces represented by options at $35, $40, and $50. These levels act as magnetic fields. As the price approaches them, the pull becomes stronger. The dealers become the biggest buyers in the room. They are effectively squeezing themselves. And remember, the US banks have flipped long. This means they might be the ones buying the calls now, forcing the foreign banks, who sold the calls, into the gamma trap. It is weaponized math. JP Morgan buys a boatload of $50 calls. The European banks, who sold them, now have to buy silver futures to hedge. JP Morgan's purchase forces their competitor to drive the price up. which makes JP Morgan's calls more valuable. It is a masterpiece of financial destruction. The gamma squeeze is violent. It doesn't give you time to think. It doesn't give you a dip to buy. It just rips. It opens at $30, trades to $35 by lunch, and closes at $38. The next day, it opens at $40. Why? Because the options market is short gamma. When the market is short gamma, stability is impossible. Volatility breeds volatility. The higher it goes, the more they have to buy. It creates a vacuum above the price. And the AI knows this. The sophisticated hedge fund algorithms hunt for short gamma environments. They look for markets where the dealers are trapped. They found it in silver. The CFTC report confirmed that the street is offsides. So Monday morning isn't just about trend following. It is about triggering the gamma avalanche. The algos will try to push the price specifically to trigger the $35 strike price. Once that domino falls, they push for $40. They are knocking down the dominoes one by one. This removes human emotion. A human looks at a chart that has gone vertical and gets vertigo. They want to sell. The machine looks at a gamma squeeze and sees maximum velocity. It holds. It presses the gas pedal. This is why $100 is not a dream. In a gamma squeeze, prices disconnect from reality. Nickel went to $100,000 a ton. Did the utility of nickel change overnight? No, the dealers got squeezed. Silver at $100 is simply the mathematical result of unwinding a massive unhedged options book in a liquidity vacuum. The panic on Monday is the realization by the option sellers that they are dead. They are standing on the beach and the tsunami is 50 feet high. They can't swim. They can only try to buy a boat, silver futures, at any price, but everyone else is buying the boats too. This mechanism is the most powerful force in modern markets. It overrides fundamentals. It overrides news. It overrides the dollar. When gamma takes the wheel, the destination is determined by the strike prices, and the strikes go all the way up. We have the catalyst, banker flip. We have the drivers, AI algos. We have the engine, gamma squeeze. Now, let's talk about the road ahead. Let's talk about the vacuum to $100 and why this trend is unstoppable. In technical analysis, traders look for resistance. They look at past peaks, $30, $50 from 1980 and 2011. They think, there are a lot of sellers at $50. This is old thinking. This is human thinking. The AI analyzes the order book. The order book lists all the limit sell orders sitting above the current price. Right now, because of the vault vacuum and the industrial famine we discussed in previous videos, the order book is thin. There's very little liquidity sitting at $40 or $60. The sellers have left the building. When the algos and the gamma squeeze chew through the resistance at $35 and $50, they enter a zone of zero resistance. This is the vacuum. There is no one left to sell. The holders are strong hands, Samsung, stackers, central banks. The weak hands, speculators, have already been washed out or have flipped long. So when the price clears $50, it doesn't grind to $51. It teleports to $60, then $70. The moves become wider. The volatility expands. This is what a super spike looks like. It's not a ladder, it's an elevator shaft. The AI models predict this. They see the air pocket above the all-time highs. They know that once silver breaks its historic leash, price discovery enters blue sky mode. There is no history to guide us. The price will go as high as it needs to go to force a holder to sell. And what is your price? $100? $200? $500? For many of you, the answer is never. You aren't selling for fiat currency that is collapsing. This psychology, the hodl mentality, is also being priced in by the AI. The AI knows that the float, the tradable supply, is effectively zero. So Monday morning triggers a sequence of events that ends at $100. It might take a week, it might take a month, but the trajectory is locked. The panic buying will come in waves. Wave 1, the algos, Monday morning. Wave 2, the insiders in industry, midweek. Wave 3, the retail public, FOMO. The retail public is the final stage, the fear of missing out. When silver hits $50 and makes headlines on CNN and Fox Business, the average person will wake up. They will see gold at record highs. They will see crypto flying. And they will see silver moving faster than anything. They will rush to open accounts. They will rush to buy coins. But remember, the algos have already bought. The US banks have already bought. The public will be the fuel that pushes the price from $70 to $100 and beyond. They will be the ones buying the top of the short-term spike, providing the exit liquidity for the fast money bots. But you are already positioned. You watched the videos, you saw the data, you didn't wait for the AI to tell you to buy. You front-ran the machines. This is the advantage of being a contrarian human. You can see the big picture that the machine misses until the data confirms it. The trend is unstoppable because it is structural. It is not just a chart pattern. It is a breakdown of the supply chain met with a breakdown of the suppression scheme. The AI is simply the accelerant. It is the gasoline. The fire was already burning. So what happens on Monday? Expect volatility. Expect halt trading. The exchange has circuit breakers. If silver rises too fast, they pause trading for 15 minutes. This is designed to cool things down, but in a gamma squeeze, it has the opposite effect. It creates more panic. Why is the market halted? I need to get in. When the market reopens, it gaps up again. We could see limit up days. We could see Silverlock limit up day after day, just like palladium did, just like lumber did. You turn on your screen, and the price is just a flat line at the top of the chart because no one is selling. This is the endgame of the manipulated market. The spring uncoils violently. The AI algorithms are not the villains here. They are the executioners of the old order. They are destroying the short sellers with ruthless efficiency. As we approach $100, the narrative will change. The media will call it a bubble. The banks will warn of a crash. But the physical market will remain empty. And as long as the physical market is empty, the price has to go higher. So do not panic on Monday. The panic is for them. The panic is for the foreign bank risk manager. The panic is for the naked call seller. The panic is for the industry executive who forgot to hedge. For you, Monday morning is validation. It is the moment the machine finally agrees with you. It is the moment the buy light turns on and stays on. Sit back, watch the green candles, watch the volume spikes. Watch the financial news anchors stutter as they try to explain why silver is up $5 in 10 minutes. The algos are in control now, and they have one destination programmed into their GPS, $100. I'm Asian Guy. The machines are awake. The squeeze is on. I'll see you on the battlefield.